JJ the CPA here. Hope you're doing well. All right, employee retention tax credit, so many intricacies I wanted to address in this video. How do you go about reporting it for federal income tax purposes? And as a side note, how would you go about reporting it on your books, if you will? So let me be clear on this. The employee retention tax credit is a payroll tax credit, meaning it reduces down your payroll tax, and then there's a refundable aspect of that that comes into play. So just a little bit of the mechanics that will be very integral to what I'm getting ready to share with you on what I believe we need to do, even though there is no concrete answer on this yet from the IRS. But when you get the employee retention tax credit, meaning you've qualified for it, you've taken it, you've received it, you've reported on Form 941, so you've met all the qualifications, and now we're to the extent and we're at the point of, okay, you got it, you reported it, you took a credit for it, you carried it over, you did your 941 or your 941X or your 7200, all that. This has nothing to do with any of that, okay? But we are talking about the employee retention credit because now we're dealing with the aftermath. What is the aftermath? Well, the aftermath is you got a credit. What was that credit? Well, it actually was two aspects. The first aspect of it is what is called the non-refundable portion of the employee retention tax credit. What? Well, JJ, I got money back. So what do you mean it's non-refundable? Hear me on this. You still got the credit. Boom, right? We know in 2020, it's 50% of the qualifying wages. We know that in 2021, it's 70% of the qualifying wages with all the other things that go into it. My point is saying you got a credit, right? Well, the way the law is written is that first, that credit reduces down the employer's portion of Social Security taxes on wages. What? So if an employer pays somebody $100,000, well, there's going to be taxes withheld from those wages, but the employer has to kick in 6.2% for Social Security taxes on that example, okay? So when you're then looking at, now not per employee, okay, this is not per employee, you have collectively a tax credit, the employee retention tax credit. The first thing that happens of the two aspects here is that the credit first reduces down the employer's portion of Social Security taxes. So very simple example, the math may not work, so don't even try and figure it out, because how could you? There's too many scenarios, but here's the math. Somebody gets a $10,000 employee retention tax credit. Doesn't even matter which year, they get a $10,000 employee retention tax credit. And just for grins, okay, let's assume that the only Social Security employer tax is $6,200, okay? So it could be two employees, they each made $50,000, their wages qualify, you have $5,000 tax credit on each, so you have a $10,000 tax credit. Forget that these are on the employees, forget that it's been broken out to you in the example. I'm telling you how you could arrive at that pretty easily. So you have a $10,000 tax credit, employee retention tax credit, a payroll tax credit. But now, for federal income tax purposes, how do you account for this? Okay. Well, $6,200 of that $10,000 tax credit is quote unquote non-refundable. Just hang on. Don't twist on that one. Don't worry about the word non-refundable yet. Okay. You still got the credit. You still got a credit for $10,000. Okay. But then the refundable portion of that $10,000 credit, okay, is $3,800. $6,200 of it is non-refundable and $3,800 of it is refundable. Now you have to forget now about, well, wait a second, I put in a Form 7200 and I got $10,000, JJ. I got $10,000. Yeah, you did. You did. So I'll invite you to go through the calculation on a Form 941 to really see the mechanics of this, but you'll need to trust me. Go through Form 941, run the math, and it'll pop out to you. But when you're looking at now recording it, because this video is about how does this affect for federal income tax purposes, because this is a payroll tax credit, but now you had $10,000 reduced of something, reduced of taxes and reduced of wages. So technically, right, because we live in the technically, what has happened for federal income tax purposes is that you're going to reduce down your tax deductions by 10 grand. And it can't be said that it's unfair. The PPP and the EIDL grant out of the Appropriation Consolidation Act were deemed to not affect your tax deduction. So if you get PPP forgiveness or you got the EIDL grant, it does not affect your taxes. It does not reduce down your deductions on the PPP and the EIDL grant. However, with the credits, they do. The thing to note here is tax credits have been around for a long time. Tax credits here's how they work for federal income tax purposes. This is nothing new when we're talking about payroll tax credits. So payroll tax credits, when you get that credit, it is going to reduce down your tax deductions. So technically, what did it reduce down? Well, on that $10,000 employee retention tax credit, $6,200 reduced down the employer's payroll taxes. So technically, what becomes a reduction of deductions is payroll taxes to the tune of $6,200. And then wages get reduced down as it relates to the deduction, in this example, by $3,800. Okay. There's still a reduction of the deductions. There's still a reduction of expenses of 10 grand. It's just that there's the two categories technically. So now it's, well, what year do we report that in? So I'm so glad you made it to here. Okay. What year do we report this in? Okay. Because even if you conclude like, yeah, I get it, JJ, I'm going to have to reduce down my expenses by 10 grand. Okay. Well, what year do I include that in? Well, we don't have any real direction on that. And it's based on your method of accounting. It's going to be based on a number of things. So I will tell you this up until this moment of shooting this video. So right before this video, my thought was, well, with my clients that are getting it, we've got retroactive, so they're getting the credit in 2021. And if they're getting the credit in 2021, then I'm going to recognize it as a reduction of deductions in 2021. You don't need to shake your head, okay? Because there's nowhere, anywhere that we can find to tell us, do we do it in 2020 or we do it in 2021, okay? It seems to be like dealer's choice. But I am telling you this, I am going to make the adjustment on the 2020 tax return for the credit that they receive, even though it's in 2021. It's because it's related to 2020 payroll. And I'll explain to you why I've come to that conclusion. That's my conclusion. If you want to do the adjustment in 2021, I think you can make a case to do it in 2021. But then how am I going to report it on the tax return? Well, you could say that, well, on the tax return, you're going to reduce down your taxes by, in that example, $6,200, and you're going to reduce down the wages by $3,800. Well, since I began practicing now almost 28 years ago, anytime that we're having to do this with a tax credit, most of the time it's been related to an R&D tax credit, but I do what I was trained to do and thought to do, and then how I've continued to do it, because it seems the most logical, and it does seem to be very well and widely accepted, which is this. On my clients' tax returns, in the other deductions section, I am going to have a negative employee retention tax credit line item. So I'm going to list employee retention tax credit, and in that example, minus $10,000, it will reduce down the deductions by $10,000. Now, you wouldn't be wrong to go and reduce down the taxes by $6,200 and reduce down the payroll, the salaries and wages, by $3,800. It still results in the same thing. Why am I doing it that way? Well, the reason I'm doing it that way is that it sticks out like a sore thumb, either for myself, for a future audit, any third party that looks at tax returns. I never provide tax returns to third parties, but we know third parties, for example, banks, they're looking over tax returns that they got from the client. And so then it sticks out like a sore thumb what that is. Now, we do know it does not get included in gross income. Some credits get included in gross income. We don't need to address that. The employee retention tax credit does not. It is a negative expense. Now, why am I going to include it in 2020? Well, because it's related to 2020 payroll. And consistent, I have anytime in circumstances where we have a client and payroll was ran right before the end of the year, but then some of the taxes are getting paid in the next year. FUTA, federal unemployment tax, state unemployment tax, withholdings, retirement contributions, retirement amounts that were withheld and then paid in later, you name it, okay? So yeah, my clients are cash basis, but as you're going to see, the IRS allows it, and there's specific rules that they allow in circumstances like this for you to, even if it was paid and even if you're cash basis and you have an expense, if you will, that's paid following the year, that you can include it in the year in which it was in essence paid in terms of payroll. So there's some rules related to payroll, although we're not going to find anything that I could, and there's many articles that everybody's drawing the same conclusion. There's, as it relates to the employee retention credit, it's like, well, don't have anything on point. So if the IRS comes out with something, that'd be great. Today is February 3rd of 2021. But I'm going to quickly just go through and some of the areas for you to take a look at. But right out of the CARES Act, it indicates right here, other certain rules that apply. This is what we have to go with, right? You ready? That's it. 280CA, 280CA. So what the IRS is given from the CARES Act is, okay, hey, for codes for this section 2301 of the CARES Act, apply 280CA. Apply code section 280CA. All right, so let's go ahead and take a look. The IRS has a couple of FAQs, and if I hadn't mentioned it already, I did do a deep dive employee retention tax credit seminar. It was 2.5 hours with a PowerPoint, and then I did 3 hours of FAQs. Why am I telling you that? Because there's a link in the body of this video that you can click on and get immediate access to watch that seminar, that 2.5 hours of 3 hours of FAQs, and you'd be able to get immediately also the PDF PowerPoint. And in fact, I just pulled up here, you will get immediate access to this private web page right here that basically is breaking down that you get the PowerPoint. You're going to be able to watch that long video. I have a private video where I do deep dive research into ensuring that we're fully aware of what businesses should qualify for the partial and full shutdown, plus all of these items here, links, spreadsheet, flow charts, Excel spreadsheets, examples. And then I did really in a lot of this as well, pull together everything related to ERTC. You have it all in one place. So you definitely could find some of this in the public domain, if you will. Things that were related to the PPP, I've got that. And then I've got 3 new sections that I've added since the seminar on aggregation related individuals, and now on the employee retention tax credit reporting for federal purposes. So on the FAQs with the IRS, which you can go to irs.gov and go to employee retention tax credit and go find FAQ 85 and 86. And it says, does the employee retention credit reduce the expenses that an eligible employer would otherwise deduct on its federal income tax return? Yes. Number 86, does an eligible employer receiving an employee retention credit for qualified wages need to include any portion of the credit in income? No. Okay. So what it's saying is it's not gross income, but it is a reduction of your deductions. Now, in 85, it references what was referenced in the CARES Act, which is code section 280CA. Well, let's go ahead and pull that up. You can Google it and find it on the web page. If you're a part of the seminar and get access to the seminar, I have a direct link to this. But we have 280C, and we're dealing with A, right? So 280CA. So rule of employment credits. No deduction shall be allowed for the portion of the wages. Boom. Okay? So basically it's saying from the code section, not going to be able to get a deduction of the wages or salaries, or in essence, in this example as well, the taxes, as it relates to the credit. And then it gives you some other code sections if you want to deep dive that a little bit more. Quite interesting. It also references 52A and B, because what you do have to take into account is aggregation rules with the ERTC. With that being said, if you go to publication 538, which I also given a link to you, and you go to page 12, on page 12, it talks about exception for recurring items. What are we talking about here? So I'm in the section here. We've got accrual method. Of course, we have the cash method, right? So it goes through both of those, and then it goes into these areas of exceptions, okay? So we're now going into the area of the exceptions. So if you have an expectation, you have a recurring item, okay? It talks about the taxes here, recurrence and consistency. It definitely leaves room that you're able to, in these circumstances, what this is addressing is the taxes that are paid in the following year that apply to the taxes that have been made due with wages in the prior year. Well, you write them all off in the year of the wages. And the reason for that is that it's been committed to, not talking about committed to paying a vendor or paying on anything else. I'm talking about related to the taxes. Now, I don't like doing this. I do not like doing this right here. But I did find that EY, which is a CPA firm, also the tax advisor, which is part of the AICPA, Grant Thornton, and then another tax advisor, these things dance around it, okay? So in this right here, I would really consider this a research memo. There's no opinions really in here. Just, I mean, this is just dissecting the law upon the law, looking at the law, boom, 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 boom. But they have a great section in here on financial reporting considerations. And when you read through it, basically, it gives you not much of a conclusion. It basically gives you a lot of information to take a look at. And basically what I think it's going to come down to is, well, how you been treating it before? How you been doing it before with the client? And for me and my clients, anytime there's any payroll items that are paid in the following year, well, we set it up as a payroll liability and we deduct it in the year of the payroll. So I'm going to be treating the credit the same way, meaning even though it's a credit, it's not a quote unquote liability, even though the credit's being received in the following year because it's related to the payroll in 2020, I'm going to, in essence, reflect it on 2020 and reduce down the deductions in 2020 for the employee retention tax credit that my clients got in 2020. But as you can tell, that's because I have a 28-year history of doing that. I have clients I've worked with for 23 years, and we've done it that way every year. So being consistent is many times what gets us a good answer when we're in this much gray. Now, this tax advisor is talking about the opposite, okay? This came out in 17. It's not talking about the ERTC, but what it addresses, though, is matching up payroll items paid in the next year and how you're able to report them if you choose in the year of the payroll. And the reason I'm even mentioning is it gives a court case, the IRS's, view on it and regs and things like this. And really what it comes down to is that it's really the election of the business. Cash basis doesn't really come into play. It's that it's a recurring item. And so anyways, that's why I've included this for you to be able to pick it apart if you want and give you some references and give you some code sections. Again, this has nothing to do with the employee retention tax credit, but it has to do with payroll and things that are reflected in 2 different years. And then Grant Thornton did an article, and I really consider it a research article. Yeah, it came out in June, but it's a research article. What was interesting here is that they're addressing in this section here, not the ERTC, okay, but what they're addressing here is an employer that deferred Social Security taxes under the CARES Act. Okay, well, what year do you report that in? Well, that's in the exact same hemisphere, if you will, of what we're trying to accomplish here, which is, well, what year do you, in essence, reflect that tax credit for federal income tax purposes? And then it does talk about it further down here, and it does address the other aspects of the CARES Act, mentions the ERC. And then this one, okay, this last tax advisor, and if you get access to the video or the seminar, I've got links to this. I'm not going to put links in the body of the video, but you'll just get a link if you went to the seminar. Because why? Because I don't like linking articles. But let me be super clear. This one's all on R&D, has nothing to do with ERTC. It's all about R&D, which is not even technically fully a payroll tax credit. Now, R&D tax credits affect payroll because payroll's included in determining your R&D tax credit, research and development tax credit. This article, though, addresses when you get a tax credit, but you experience it in the following year, what year do you then report that tax credit as a reduction of your deductions? So it is parallel to this predicament of determining which year should you record this tax credit for federal income tax purposes. And really, at the end of the day, it's one of those that it's what's your accounting method? Cash doesn't come into play. Accrual doesn't come into play. And it seems as though you can really go either way on this. But why am I including it then? Well, it's giving you code sections in here as well to take a look at. Now, of course, it's going to give you code sections related to the R&D credit. But we all know when we're doing tax research, we have to look at other code sections because code sections get, in essence, reflected like we saw in the CARES Act. The CARES Act says go to section 280CA. So we go to 280CA, and then it references these code sections here that may come into play. So the reason I'm giving you these articles, okay, this one, this one, this one, and this one, is that they're around it, kind of about it, but it's the same issue. It's the same issue of something related to payroll, because even the R&D, it's related to payroll because payroll's included in R&D credit. But these are things related to payroll that payroll's incurred in this year. In our world right now, we have payroll that was incurred in 2020, but credits and liabilities are in 2021, experienced in 2021. So where do you report them? Do you report it in 21? Or do you report that in 20? So because I've done it the way that I indicated to you earlier for every single client since the beginning of my career and throughout my practice and with these clients, then I've concluded that I'm going to follow suit, be consistent, and report that credit, report that reduction of a deduction on 2020. I told you how I'm going to do it on the tax return. And I'm going to do it the same way on the books, if you will. So that tax credit, we know that the taxes and the payroll, well, there's a credit there that got it reduced down. Or back to what I was talking about at the beginning, if you put in a 7,200, you literally got a check for 10 grand. It doesn't matter that technically some of it was refundable and some of it was non-refundable, because that's all the semantics that go on a Form 941 and where it applies to. At the end of the day, there's a $10,000 tax credit. So it's easier to think of it this way. You got a deposit in your bank account for 10 grand. Where does it go? Well, they indicate right here in the FAQ that I shared here a second ago that you do not include it in income. It says that in number 86. We do not include it in income. So I'm going to include it as a negative expense. So where am I going to put it on my financials for my clients? I'm actually going to put it down in other expenses, and it's going to say employee retention tax credit, and it's going to be $10,000. And yes, it'll be a negative $10,000 because when it goes into other expenses, well, it was a deposit, right? It's a credit, meaning it's a negative expense. And why am I doing that? Well, for the client, it stands out like a sore thumb when we're doing comparisons from one year to the next on payroll and taxes. We know other third parties look at clients' financials and they're doing analysis. Okay, well, I think that those things should be broken out separately, meaning here was the payroll and here was the payroll taxes. And then all the way down below in the other expenses that no one would forget because, first of all, it's a big fat negative expense. That it'll stand out like, oh yeah, that's the employee retention tax credit. So especially with the ERTC that came out of the CARES Act and those that are able to take advantage of it related to COVID-19, this is a once occurrence in 2020, and now we know a once occurrence for the first 6 months of 2021. All right, hey, hopefully that was helpful. This definitely came out of the FAQs, had a number of questions. So hopefully those that attended the seminar, I was able to expand on this. And so I did 3 additional videos past the seminar. So the seminar, if you signed up for it, or if you sign up to get immediate access to it, there's 5 videos. Okay, there's one video that's the private research video that talks about the partial and full shutdown. And then the second video is over 5-hour video, 2.5 hours of my presentation of the seminar with well over 100 pages of PDF of the PowerPoint. And then I have 3 additional videos that I've posted today about aggregation, related individuals, do the owners and the spouses qualify for ERTC, and then this video talking about reporting it for federal income tax purposes. So I've got more videos that'll be coming out related to this, but this, in essence, I feel like puts together a package related to the seminar. I also do have a link in the body of this to a playlist about any video I've put out related to the tax credits, some of which include the paid family leave credit as well as the sick leave credit. All right, so listen, if you made it to here and you're not a subscriber, you're going to hurt my feelings if you don't subscribe now, because how did I not provide some value to you that you waited all the way to here and we went through all that materials? And when I shoot a Zoom, my mouth may not even be lined up exactly how I'm talking, and you put through all of that and you got to here and you're not a subscriber. I think I've convinced you. Should. Love it if you'd subscribe. I would appreciate that. Subscribers, love you. Hope you're doing well, and turn on your notifications. And with that, I will say, don't you ever forget, you've never met a CPA quite like me. Have a great day.